Hello, good evening, ladies and gentlemen, fellow investors. Apologies for the late start. A bit of technical issue here. So if you can hear me fine, can you comment a hi or good evening? Okay. And meanwhile, if you are at it, please help us to like and also share the live session today. Okay, once again, if you just joined the session, apologies, we have some technical issue just now. Supposed to start at 8, but no worries. We try to um, share with you all what we are supposed to be sharing today. Okay, so meanwhile, we're going to wait for a little bit, probably for a couple of minutes for more people to join in. Hi, Jeremy. Good evening. Okay, if you can, please help us to like and share the video so that more people can actually see the session. Okay, and if you are not aware of what are we going to do today, we're going to briefly talk a bit about the recent macros of the Singapore market, and we're going to discuss on specifically 5 to 6 quarterly results, quarterly announcement by the top traded companies over in Singapore, the more interesting ones. Probably you guys are also shareholder of it. And we'll see after that if we have any Q&A that comes in. Okay, so if you have any Q&A throughout the session, please feel free to leave your comment below, or if you have any really interesting Singapore companies that you would like to discuss, we will try to discuss it throughout the session. But if we couldn't, or I do not know the company myself, then I couldn't help it, but you can still talk to me. I'll try to work out something for you all. Okay, so once again, ladies and gentlemen, welcome to our session tonight. Just a very brief introduction, and thank you very much, Equities Tracker, for having me tonight on the topic of spotlight on earnings and what to expect from SGX companies this quarter, right? You can see I already have all these tabs open. Later on, I will show you what Singapore companies are doing in the sense of them sharing the presentation slide publicly. This is something that unfortunately, Malaysia, Bursa, not a lot of companies are doing this. A bit unfortunate, but the major banks, they do this. I'll show you later on. All right. Just a quick disclaimer before we begin. This session is meant for educational and informational purposes only. And by no means we are going to give you any form of investment advice or in any form of recommendation of securities. It's not for you to act on it, but just for your information and just for educational purposes only, right? With that, we're going to start the session today. All right, so just a very quick overview of what happened in Singapore market recently. They have quite a bit of challenges in terms of the total economic growth. The quarter on quarter, in terms of what their MTI has announced, has dropped by 0.6% in terms of the economy. But year-on-year growth still okay, 3.9%. That's on the macro side. Their core inflation, I think, increased by 0.7% in over in April. And I think it's still below 1% growth for the 4th consecutive months. But I think this is not what you are coming in here to listen. Most probably than not, you're coming in here for stock related, right? So we're going to look at the year-to-date basis. Actually, year-to-date basis, the STI index, which is equivalent to our FBMKLCI index, has delivered 2.58% year-to-date performance. But I think this is also because of the panic crash after the Liberation Day. Second, I mean it's third over in Malaysia and also Singapore. Right after the Liberation Day, the STI index actually crashed. But sorry. Okay, sorry. Yep. So let me check if you guys can see my screen. Yep, cool. Okay. So on a year-to-date basis, you can see that it's plus 2.58%. And on annualized basis, I think this is a bit, we are still in the month of May. And if you're actually able to capture on this bottom, I mean DBS, one of the companies we are going to discuss today, actually has a very steep discount, I think below 38 Sing dollar per share, right? It's a very good bargain at the time, but of course, what has already passed, and the market has already rebounded currently. And if you look at the analyzed return for STI, right, actually it's quite decent over here, right? Especially if you calculate, you also factor in the conversion of the currencies in this period. Okay, so that's the very quick overview of the Singapore market, what has happened. And of course, in terms of the other indicator, interest rate, I believe the Singapore, correct me if I'm wrong, also adjusted 2 times to downwards this year. And I think we probably going to see a more, not to say very aggressive, but more gradual adjustment in terms of the interest rate over in this year. All right. So when we mention about interest rate, the next thing we cannot miss, or some of the companies that we're going to talk about in terms of their quarterly report, is definitely on some of the banks, right? Okay, let me check if my screen is fine. Okay, cool. Okay, so one of the companies that I personally like a lot is, of course, a lot of investors, I believe they would also love it. It's probably on the DBS. Okay, so on this quarter, DBS, they had another quarter of record earnings. I think PBT around, as you can see over here. Let me adjust the pages for a bit. Yep. Okay. So as you can see over here, their record earnings of profit before tax of Sing dollar 3.44 billion. And as a bank, say DBS, if you do not know, is probably the largest bank over in Singapore, not probably in terms of market cap. Yeah, definitely the largest. I think they're also largest, not across the bank only, but in the market as a whole. And when we look into a bank, regardless of what markets that you are looking at, a couple of things that we need to look into, right? Number one is the interest income. So over here, we can see that they call it commercial book overall on a holistic basis. So we have NII, net interest income, which means if you see over here, they actually shows you their CASA, which is deposit, current account, saving account, just layman terms, right? In terms of CASA, they actually has an increased quarter-on-quarter basis. And when we talk about net interest income on a year-on-year basis, is that they take our deposit and then they lend it out to other people for a higher interest. So imagine in a lower interest rate environment, what will happen to this kind of interest income? It's likely that their interest income would get impacted, because ultimately how they make money is the interest spread, which is called NIM, net interest margin. I'm sure those who join us before, you will know about NIM. Just to repeat it again, the business of banking is always the same. You just take in deposit, what we call current account, saving account. If you do fixed deposit, great, they give you a better rate, but also it's more stable for them in order to forecast their loan availability. What are their loan books that they're able to generate, okay, at the current group level. So if you look at DBS, right, their NIM, okay, in terms of group level, if you look at their NIM, is currently at 2.12%, which is largely in line with the Singapore banks, the other banks, right? If you look at their quarter report, as you mentioned just now, it was somewhat also impacted by the interest rate downwards issue that the MAS has adjusted, same like Malaysia. If you're in Malaysia, BNM going to adjust their OPR rate, overnight policy rate. So the banks is likely to get their NIM adjusted also. Is the same thing over, right? Just this is in Singapore. NIM is actually around 9 basis point down in this quarter, but due to their loan book increase, if you see over here, their commercial books actually still increase. You see the spread of the margin drops, but because of their more aggressive stance in terms of getting businesses, right? They actually increase their overall performance in terms of total income and also the PBT on year-on-year basis increased by a 1%. Is now 1% may or may not sound no, sorry. I saw, just to clarify, guys, I saw a comment from YouTube. Thank you for the question. OPR is not equivalent to NIM. MAS interest rate, their adjustment, which is their central bank, whatever adjustment in terms of interest rate by MAS in Singapore is equivalent to Malaysia's Bank Negara OPR adjustment. So net interest margin is basically, let's say today I'm DBS, right? I take in your money, you put in 10,000 Sing dollar to the bank to deposit, and then I loan it outwards towards someone who want to buy a car. So let's say I pay you 1.5% in terms of the interest, but I charge the guy who want to take a car loan maybe 3.5%. So this 2% spread in between is what we call net interest margin. And this is the NIM that we had mentioned just now. Okay, so just for information, sorry if I confuse you a bit, right? So when the NIM comes down, assuming on a, because bank, they have two types of what we call interest. Like if you buy a car, it's very likely that your loan is fixed in terms of the interest rate. This is what we call term loan. But when you buy a house, sometimes you have semi-flexi loan, you have flexi loan, you have also fixed loan, right? So a lot of types. So for flexi loan, it would adjust. If you talk to your banker, if you buy a house, if you talk to a banker, you get a flexi loan, because when the interest rate comes down, your loan payment, your interest will also goes down, and you will pay a lesser interest. But what happens to the bank? The bank, if they take in your fixed deposit, assuming it's a FD, right? If they take in your fixed deposit and they collect the fixed sum, the interest sum, which is adjusted downwards from you, the NIM would decrease. That's how for the banking to works. But for the car loan, it doesn't matter. Let's say someone mentioned OPR. OPR just up, just down, doesn't matter. You pay the fixed amount every month. But how does bank make more money during this kind of time? There is another way, which is to increase their loan book. They put out more money available in terms of loan to lend, so that they can increase their interest income over here, right? Plus 2% in terms of the what we call commercial book level. And then we also have non-fund based income, which is fee income. When you go to the bank, I'm not sure about your experience. When you go to a bank, you want to open an account, you want to get a credit card, you want to sign whatever things that you want to do. It's likely that when you go to a certain counter, someone will approach you, and then they'll ask you, hey, do you want to sign up for this insurance product that we have, or do you want this wealth product that we have? These are the additional income that the banks would generate, which is coming from the fee base, whether it's a commission from selling additional financial products, wealth products, or they provide wealth management services, or they provide brokering services, or even on a banca assurance services, which when you buy a house, normally they will also assign insurance for you to buy at the same time. So banca assurance at the same time would run also. So this is how they make their fee-based income. Now, based on what I have observed over on the Singapore market so far, actually across the board, not only DBS, we'll talk about OCBC and UOB later on, their quarterly results. And you can see that actually most of the banks, NIM, yes, decrease interest income apart from DBS. Other banks actually decrease over in Singapore, but their fee-based income increased at the same time. So it's a very interesting time that we are in now. Okay. And if you look over here, market trading income, which is the bank trader, and of course also includes their clients trading also, increased by 48%. This is really interesting, market trading income, right? So this is something that additionally that they are doing for this period of time in Q1, which is on January, February, and also March 2025. I think the bank and also the traders, they have quite a good performance back then. A lot of people make money, from Forex, for equities, and also derivatives in the the first quarter of 2025. But of course, April is a different story. We may or may not see lower market trading income because of the Liberation Day. So they might suffer losses, a lot of cut loss in between. Although rebounded, I'm not sure whether they can capture the rebound so swiftly. Okay, so market trading income also boosted the bank's performance in this quarter. And we talk about the ability to generate revenue and profit. There's also one very important indicator that we should look for when we are looking into banking stock, which is the NPL. What we call non-performance loan, which means the loans that are defaulted. Normally, they have something, it's much more complex. They would depreciate after a couple of months. They would depreciate. Let's say, I expect I couldn't collect this loan. I couldn't collect the interest back, or this loan is completely gone, right? 100% written off from their books, which is the NPL ratio, 1.1%. And NPL ratio, just for your perspective, right? NPL, I think is 1.13 exactly for DBS. OCBC is doing 0.9%. And DBS, alongside with their loan book growth, right? You can see their NPL actually increased by a little bit. And OCBC more prudent at the same time. Probably they don't see this much growth, although they also have loan book growth, but not so much, right? So this is a decision for the banks to, risk management decision. Whether I want to be more aggressive to give up more loans in exchange for more, of course, interest income, right? I also charge you a fee, all these miscellaneous fee, also fee-based income. And also when you are having late payment, of course, there's also additional income for the banks. So it's a decision whether I want to lend out more money in this time, right? In a downwards interest rate environment, of course, I'm going to lend out more at a fixed rate now. Because if I lend out a quarter or 2 quarters ahead, probably the interest that are chargeable is lower at the time, right? And we can see DBS NPL is 1.1%, OCBC 0.9%. UOB, if I remember correctly, is maybe somewhere around 1.5%. And to put this into perspective, Malaysia, our bank's NPL is somewhere in 1.4% and 1.5%. Of course, this could be regional issue because DBS is in 18 countries, and a lot of banks in Malaysia usually is in Malaysia or Indonesia, Singapore. It's smaller in terms of regional basis, right? So NPL is a thing that investor, you and I, we should consider when we look into a bank from a risk perspective, from the aggressiveness of them to enhancing their loan book, right? And in terms of the costs, right? One moment, guys. Okay, cost to income ratio, right? You can see it's quite tally with Q1 2024 and Q1 2025 is 37%. It's proportionate of 1 ringgit of income, 1 Sing dollar of income, how much they spend in that proportionate. And you can see it's quite stable at 37%. So there might be a cyclical factor here, which means Q1 normally their cost to income ratio is more lower. But Q2, you might see some people, after they taken the bonuses, then they will leave. And the bank would have to put out more money to hire, additional talents and to train them. You imagine the time loss and also the additional cost, monetary cost involved in this. And as an investor, apart from this data, right, I think this is seasonal. If you're truly invested in the company, probably you're over for a long term. This is for review. And something more interesting is the dividend that DBS is doing. They're doing something more special. If you look over here, specifically this line over here, right? Okay. So what happened here? DBS in this quarter alone, they announced 75 cents in dividend. And if you translate it to the share price today, which is around 44 plus minus Sing dollar, I didn't really look at the closing today. It's around 1.6% dividend yield this quarter alone, right? And if you look at the sentence here that I've highlighted, their ordinary dividend, which out of their ordinary cost of business, like business as usual, nothing special. Normally, they give you 60 cents in terms of dividend based on their policy, based on their board approval and whatnot. But this quarter, they actually pay you 15 cents dividend extra, which is an initiative. If you look back into their previous announcements, they have committed to distribute 15 up to a X amount. I don't really recall a number. I think it's around 2 billion or 3 billion, right? Excess capital that they have accumulated for the past few years, which means the company has earned a lot of money previously. Now they want to reward shareholder looking ahead. And not to mention, I think they also have an initiative to do some share buyback, right? Which share buyback, I believe there's a mix of audience here. Some of you might be newer to the market. Some of you might be very familiar. And for those who are newer to the market, share buyback is usually a good thing for the company. Why do I say so? Imagine that there's a pie that we cut into 10 pieces, right? Share buyback is an act that they reduce the number of pies should be cut. So let's say one people left. I know that it's not very straightforward analogy, but this is what I'm trying to express. When a company does share buyback, the number of shareholders will decrease. Just put it on a very simple sense, right? Number of shareholders may decrease. Then imagine the profit that a company earn is able to distribute to more shareholders. So this is very famous over in the US market, but looking at the announcement over in Singapore, I think this is getting more and more favorable over in Singapore, because I see not only the banks, the top 3 banks, UOB, DBS, OCBC, they are doing share buyback over the next course of 3 years, but also other companies, they are also doing the same, right? So let me just take one question here. Again, just a disclaimer, I cannot give you any form of investment advice because I'm not licensed to do so. But if you're looking at a stock for dividend, right? DBS, I think they're trading at currently 6-point-something% in terms of dividend yield, which if you ask any dividend investor, I think a 6% is the quite decent kind of dividend yield that we are able to get. But the next thing you want to ask yourself as a dividend investor is, how consistent can this company pay me dividend, right? Let's ask ourselves, compared to other companies, for the next 5 years, can DBS continuously grow and pay me more and more dividend every year? Evidently, if you look at the historical performance of DBS, the answer is yes, right? If you average it out over 10 years, can they increase the dividend payout? Not increase dividend payout. They increase our absolute dividend amount that they paid over the past 10 years. The answer is yes. But again, no guarantee over the future. But as an investor, these are the things that we need to see. Number one is the current yield. If I buy in at this price, what is the yield that I'm probably going to get? But I think the 1.6, the 75 cents dividend has already exited. So if you buy now, probably you have to wait until August, their next quarterly report, before they announce the next dividend. Then you can only get it. Now has already passed, right? Number one is the current yield. Number two is the consistent ability that the company, thank you for the hashtag. Thank you very much. NFA, not financial advice. The ability for the company to consistently pay out dividend and to grow. Don't forget, there's also inflation factor in play. If a company is not able to deliver at least 3 to 5% growth every year, then I think it's quite pointless, because assuming you get the same amount of dividend every year, and in Malaysia, with whichever country you're in now, I think safe to say inflation rate is at least 3%. Your money is depreciating by 3% every year. So the company needs to grow at least by 5 to 6% to justify my return. Okay. So yeah, that's for the DBS. Now we're going to talk about OCBC, also another very interesting bank. By the way, if you're interested in all this information, all you need to do for the comprehensive presentation slide, because usually the quarter result is quite dry to study. It's all numbers, right? For example, this one, right? It's a bit more boring, all these numbers over here. You just type in the company name followed by the presentation slide. It's more than likely that you can get a slide on Singapore company or maybe on the US companies. Right. Now on to OCBC. OCBC, I think they are the second largest bank in Singapore by market capitalization. And one thing we didn't mention about valuation just now, when we are looking into banks, is the price to book ratio. Usually, when we are looking into banks' price to book ratio, for me, I didn't say for everyone. For me, I will look at a price to book ratio. That means the net asset that a company has, right? In the sense of the banks, of course, is their assets, is their loan that they are handling out, and also the cash they are holding, right? Price to book ratio, I'm targeting anywhere around 1.2 to 1.5 on optimal level. But DBS, because of their market proposition being the one of the largest and the strong market proposition and exposure that they have, they're priced at a premium compared to their peers at 1.8 times. I think this is still understandable, given how many people actually like DBS. When we talk about banks over in Singapore, probably the first bank that comes into your mind, it's DBS. And for OCBC, if you're looking at something, you want a more stick to the books, you want a cheaper valuation by the books, right? OCBC 1.2 times in terms of price to book value, but they're paying a lower dividend yield. Historical dividend yield of lower is 5.2% based on their latest price. So is this a sign of undervalue? So you can comment below whether you think a lower price to book ratio is undervalue sign, or is this just one of the indicators to to judge a stock whether should I invest in it, right? Leave it to you all to judge on this. Okay, so go back to their results. OCBC, they reported 1.88, a very long number if you're Chinese, very good number, 1.88 billion in their net profit, which is down 5% year on year, but it's up 12% Q on Q. One possible reason of the year on year and also Q on Q disparity is because the adjustment downwards by the MAS in terms of the interest rate, right? For a bank, they need some time to adjust the downwards interest rate. So after adjusted, they can have newer loans at a interest rate that they calculated to to get more revenue from it, but they need a gestation period. Normally, when there's an adjustment upwards or downwards in terms of the central bank decision, there is 1 quarter or 2 quarter lag usually, right? So in this quarter, we can see there's a recovery in terms of their net interest income, I would believe. Net interest income probably, yeah. They didn't fully recover. It's because the NIM still affecting them in a declining interest rate environment, as you can see over here. But as I mentioned just now, it's very interesting to see that their fee-based income has increased. Fee-based income is what I mentioned just now, wealth banking, banca assurance. But for OCBC, it's probably not banca assurance. I'll tell you why later on, right? In fact, their books growth, their books actually grow too in terms of the loan that they given out that I mentioned just now. They also given out more, but it is just not enough to counter the NIM that goes down, right? NPL OCBC super prudent, 0.9% is a fantastic number when you assign this number to the banks. And if you see in terms of the net interest income, yeah, it goes down by 4% year on year, QOQ. But non-interest income, fee-based income increased very significantly, 10% year on year, 36% quarter on quarter, right? One factor is probably on the trading, and secondly is also from the other fees. And some of you may not know, including myself, until I look deeper into the company. OCBC, they own a very substantial sum of interest over in Great Eastern in Singapore. Great Eastern, generally in Southeast Asia, they own a very substantial stake. So over here, you can actually see that they have a division, which is the revenue and profit contribution over from their insurance division, right? This is a bit special as compared to the other banks. And GE, Great Eastern, for your information, It's the largest and I think oldest life insurance in Singapore and also in Malaysia. And as you can see over here, it's contributing quite significantly over to OCBC, right? But I'm not sure if guys have this notification recently. Premium has actually adjusted upwards. More or less, I think this will, life insurance, I'm talking about life insurance, the premium adjusted upwards. That means you need to pay higher to get the same coverage. Maybe they will add something for you, but net, if you calculate the premium ratio, is probably lower. The things that you pay and the things that you get, right? For in that sense, for insurance segment. So for the GE part for OCBC, they actually see as over here, total weighted new sales, which means the new policy that they plays out actually has been lower. It's probably one of the reason because of the premium adjustment and whatnot, which has impacted them. And in conjunction with the lower number of new policies being made, their NBEV is a technical term for new business embedded value, right? Which they forecast the future value or future profits that they can get from all these insurance policies has also gone down in conjunction with the lower percentage of policies being written, right? And if you look at the ratio, sorry, let me look at the part, right? NIM is over here, as you can see, it's on a downward trajectory, but bear in mind, this is not only OCBC themselves, right? It's a holistic basis. But if you look over here, in terms of the non-interest income growth, is quite substantial. You can see year-on-year grow by 10% and quarter-on-quarter grow by 36%. Bear in mind, this is a bank, it's a mega size company. This number is quite substantial. And it has contributed 35.8% to the overall group level income, right? So if we look deeper into this part, this is contributed by trading income. One is trading income that we mentioned just now. Maybe they're trading Forex, they're trading equities, they're trading derivatives, and also from their insurance division is doing also very well. And in terms of dividend and also from investor perspective, OCBC has committed 2.5 billion share buyback program. So that means that all these banks now, I'm not sure whether it's an initiative or whatnot, right? Or they really have so much extra capital. All of them, they are planning to buy back more shares to reward shareholder. Another thing that I didn't mention just now is that share buyback may or may not drive the share price up because there's someone buying in the market, right? Unless the market is really weak. So if not, this could contribute to a buying power back to the company themselves while increasing your equities per share. What I mean equities per share is including your earnings per share increase because your share of the pie is lower, right? Your dividend per share increase also because the share of the pie is lower. So in that sense, all these banks, they're doing share buyback program is actually, if you ask me, I think it's a good thing, right? But what are the prospects ahead for all these banks? Let's say beyond 2025, maybe looking into 2026. We're going to talk a bit about that part after we finish the UOB. We're going to talk about that, right? Let me just go to UOB very quickly. Okay, now UOB net profit at 1.5 billion Sing dollar, which is quite huge in terms of number, right? If you convert it back into ringgit, if you're in Malaysia, probably one single quarter profit is probably equivalent to some listed companies market cap over in Malaysia, but it's a bank anyway. Now UOB, they are trading at a 1.3 times price to book value. As I mentioned just now, some of you might use price to book. Some of you will use dividend yield. Some of you might use other indicator with a combination of NIM, NPL, and all these factor ins. But of course, as a serious investor, you should consider all these factors, not only price to book and not only dividend yield. And back to dividend yield, UOB, they are actually paying around 5.2% based on the latest price that I have. It's paying around 5.2% dividend yield. It's quite similar to OCBC. And back to the quarterly result, 1.5 billion profit after tax net profit in the current quarter. NIM for some reason, UOB is relatively lower. They're at 2%, largely unchanged for quarter on quarter, and a slight decrease as compared to year on year, as the reason I mentioned just now, central bank adjustment. Okay, and similar trend that we are seeing here is that record high fee-based income, right? I'm not sure whether going into the next quarter they will be impacted by, the Liberation Day, as I mentioned just now. Trading income might be impacted, but we can see a trend here for all these banks. They have a strategy to shift towards fee-based income. That means they ask you to, they launch more products, or they will ask you to buy more of their products during a lower NIM, net interest margin environment, or riskier environment. They push more product to you to maintain their profitability. Now, as a user of the bank, sometimes you get a bit, frustrated. You keep getting calls from the bank. But as a shareholder perspective, I think that's a fantastic thing that the banks are doing what they can to protect shareholder value, right? UOB, they are working very closely, I think, with I think it's Manulife, if I'm not mistaken, or Prudential. I can't really recall. They don't own their own insurance division. It's more towards banca assurance. And trading in investment income, as I mentioned here and just now, trading investment income surprisingly also grow very strongly. That means that Q1 is a fantastic quarter for most of the banks over in Singapore, right? We go a bit deeper into the financial of the UOB, and you can see over here the NII, net interest income, dropped slightly. Okay, that means that their NIM, although is decreasing, but they are able to manage it somewhat. But net fee income increased quite substantially, which is a good sign. Now, if you remember just now, we mentioned OCBC. They have a lower net interest income due to lower NIM. Loan book growth is not that huge to support them. And UOB, don't forget, back in 2022, I'm not sure if you are UOB credit card user or Citibank credit card user. UOB has actually announced in 2022 to acquire Citibank. Not acquire the whole Citibank, but their consumer banking business over in Southeast Asia. I think the purchasing price is around 5 billion Sing dollar back then, right? So at that time, UOB, they actually acquire around 2.2 million new customers, 5,000 staff plus 5,000 staff. So after that, in terms of quarter on quarter, year on year, we have observed something very interesting. After the acquisition of this segment from Citibank, they have strong growth in a couple of items, like what you see over here. Okay, CASA, the saving account, the balance increased, and most importantly, the credit card, right? If you look at the bank, when you take a house loan, when you take a car loan, even personal loan, is probably not that high in terms of interest rate. But for a credit card, right, something that we use on a daily basis can be deadly, because they can charge up to 18% in Malaysia. That's the allowable maximum interest, which is 1.5%. So credit card, if you're not disciplined with it, yeah, you're contributing a lot to the bank, right? And in terms of wealth income, I think they are quite, to finish up here, their retail business after the acquisition has been going very, very well. And wholesale, in terms of investment bank and whatnot, is also quite stable on an overall basis. Now, UOB performance, what I would say, is also quite stable on a holistic basis. And their dividend payout, unlike DBS, they do it more on a half annual basis, which is payable, if I'm not mistaken, is in August. Right now we are in May. They are payable in August and April. So April has already passed. And if you buy UOB now, probably you get the next dividend in August or September. So depending on what the X date and also the payout date is. Now, looking ahead, if you look at the Singapore interest rate trend as compared to Fed rate, which is the US interest rate, usually they have quite a close correlation. Usually, of course, on certain extreme circumstances, it might change. Now, you think about the potential interest rate scenario over in US. Is it is the interest going to come down further over in 2025, or is it going to go up or maintain in 2025, 2026? Now, not coming from me, but the market consensus is basically the interest rate is going down to support all this US UHA and whatnot. And also Donald Trump is pressuring pressuring the Fed also in that sense. So when OPI adjusted to maintain the export relationship and also the not to be overly strong in terms of Sing dollar, the Singapore is like what they have to do very likely is to downwardly adjust their interest rate, which will further impact the net interest margin of these banks, right? And we already know in Q2 the trading income from these banks remain unknown, right? So, and when we know NIM is probably going to go down, if they are unable to grow their loan books, yeah, again, if you grow your loan books too aggressively, right, there is a risk that your NPL will go up. That means you'll suffer losses because you go too aggressively. So it's quite a chicken and egg issue, right? Should I go or should I not go? So the coming next few quarters for these banks, you have to consider the interest rate risk, number one, and also the second quarter, whether trading income for these banks, whether they can perform in such scenario. If you are really interested, you can backtrack in 2020 in March when the market crashed. In that quarter alone, how are their investment income performing, right? Usually it's down. Usually it's down because they also have the investment portfolio, not only trading. Trading probably, you can trade in and out and whatnot, but it's likely that it's going to down. So Q2, it's a period of observation for banks, in my personal opinion. But in this kind of timing, it's also very good that if we find any undervalued opportunity that we can leverage on. For example, I didn't really get into the April when it goes down so much for DBS. I didn't really get into it. That's a bit unfortunate. But moving ahead, when you understand these banks sufficiently, you know that DBS, they are paying out excess capital. They are having a very all three banks having a very consistent dividend policy, right? And they are doing share buyback in a sense, so to support the share price. I think UOB has 2 billion Sing dollar share buyback program over the next 3 years. So you know that the banks are supporting to buying back their shares for the next 3 years. So there's a base to it, right? So whether when you prolong your investment horizon to past 5 years, then perhaps you will have a clearer picture whether the downward trend is a good timing for you to go into it or not. Okay. And I think we have time for one more company, which is Singtel, right? Meanwhile, if you have any questions here, don't be shy. You can still comment here. I would love to interact with everyone here, right? So, yep, we're going to Singtel while waiting for more questions. And Singtel, I'm sure you guys know Singapore Telecommunication. They also announced a 2 billion share buyback program. I'm not sure about the time frame, but as I mentioned just now, we can see that an interesting trend over in Singapore is that they are doing share buyback program as part of their plan to reward shareholders. And again, I don't want to over reiterate what share buyback is. I'm sure you guys understand by now. It's a good thing for investors, and US companies love to do it, right? We can look into the Singtel business segment. A lot of people, like including myself, before I go and study, I thought they're only doing telecommunication services for Singapore only. And their bread and butter, of course, it's the mobile, fiber broadband, fixed line, paid TV services over in Singapore through Singtel. And they also owns Optus in Australia. If you're in Australia, then you know Optus. I think they're the second largest telecommunication player over there. And it's contributing hugely to the Singtel overall financial performance. Now, telecommunications industry, I'm not sure about you guys. Some people may think that, oh, it's a very boring industry. It's a sunset industry. Yeah, true. It's a very relatively, it's quite boring. And also in my opinion, I'm not sure about you guys. I'm staying in Malaysia, and telecommunication business, essentially the people have no loyalty. Today, my telco offer me 20 ringgit. Another telco offer me 20 ringgit cheaper than what I have now, and the line don't suck so much. I would shift. I have no brand loyalty. I would not stay in the, these services because I like the brand. No, it's in terms of services provided, but I think it's more or less a level playing field, right? And there's no loyalty. So telecommunication is a highly competitive industry over in Malaysia. But telco in Singapore is smaller in terms of the radius and land area. But whether Singtel has a very strong competitive advantage over there, I leave a bit of homework for you to study a bit. Apart from Singtel, who else is doing over there? Then you know whether the business is highly competitive and whether it's sunset or not, right? But beyond telecommunication, like Singtel and also Optus in Australia that we mentioned just now, they also own NCS. NCS is their ICT and enterprise solution. Later on, I'll elaborate a bit. All these NCS, what they're doing is cloud migration, cybersecurity, and digital services for MNC, for big companies, and also for the government. And they have their data center division under NZERA. I don't know the correct term to pronounce it. Sorry for that, but I call it NZERA, which they are using the vehicle to capture data assets over in Singapore, Thailand, and also Indonesia in terms of data center. So apart from the telecommunication, I forgot to mention something just now. It's also a relatively very stable business because the recurring and predictability is quite fixed over there. And also ICT, digital services, data center is the high growth part of the Singtel. And if you look at Singtel recently, they are doing something very interesting. I think it's worthwhile for a lot of traditional companies to do, which they are doing something called capital recycling and also value realization dividend, VRD. Let me show you. Okay. So basically, it's a fancy term for selling my old asset that are not producing very good return for me, and then I go and buy or invest into higher growth business. At the same time, when I sell off these assets, I would have excess capital. And for example, they sell off assets like telcosmel, towers, maybe in Indonesia, then they reinvest into higher return kind of assets, right? But they maintain a role, like a management role, a partner role, in exchange for recurring income. So all this income that they dispose of the assets, there's a potential to reinvested into the different businesses. For example, Unified, their new AI-enabled enterprise portal, right? I don't really know about this because I'm not enterprise user in a sense, but they have seen very significant growth. So they are reinvesting the capital into at least something that's growing, right? Optus ARPU, average revenue per user in terms of broadband, I think that's nothing too much special, right? But in terms of data center, AI, ICT solutions, that's a place that they're investing their capital. I think it's good. Where they, in this quarter, they have announced 17 cents in terms of total dividend, where in a normal course of their business, the dividend that they are going to pay out is 12.3 cents in normal dividend. And in terms of the VRD, the value realization dividend that we just mentioned is 4.7 cents as a whole, right? So that's two spectrum of dividend that they are paying out. And historically speaking, financial performance-wise, revenue, EBITDA, profit after tax, over here for the company, right? Financial highlights. I think they're performing quite well, as I mentioned just now. Telecommunication the industry is generally quite stable in nature. But if you see over here, net profit increased very drastically, over 400%. It's not that the value creation or capital recycling works so well that a company with a scale of right, the full financial, this is full financial year, not single quarter, that a company at Singtel level, they could have 400% growth. It's not realistic. This is because in the year before, because of a cyber security attack back in 2022 for Optus, right, they have a significant impairment over billions. I think 1 point something or 2 billion Sing dollar on Optus. So last financial year, they are doing very bad because of that one-off impairment. But core profit wise, which means we take off all these one-off items, Singtel, they still deliver quite substantial, quite decent growth if you look at a telecommunication company as a whole. And valuation wise, it's a bit different. I will move to the question by Jack Lee shortly in terms of compare DBS, UOB, and OCBC, right? Singtel is a bit different. You can't really look at price to book for them. For me, Singtel is more of a PE. PE ratio is 16.10 times. PEG, you need to look at it, their historical growth, whether it justifies or not. Dividend yield is 4.42%. Now, if you are a dividend investor, you cannot just look at the dividend yield as I mentioned just now. You also need to look at whether the continuous growth of this company will the dividend growth. Assuming if I buy at this price, right, for the next 5 years, because of what Singtel is doing, it's going to go, assuming they are going to go rapidly, are they going to pay out more and more dividend? So it justify the lower dividend yield I'm getting now. So it's also another perspective to look into a growing company when we are doing comparison by nature, right? So if you are an investor looking into Singapore market, looking into digitalization, ICT, and also telecommunication, you cannot move your eyes away from Singtel because it's one of the largest companies over in Singapore by market cap, and also it's the leading player over there, quite obviously, right? Now, before we reach our end of session at 9 p.m., maybe one last question from Jake Lee is that how would I myself compare DBS, UOB, and OCBC? For me, number one thing that I would look at is the stability of their historical financial performance, how they are performing for the past 10 years. If you are not sure where you can get this data, I think all major platforms over available now, I think like, not doing advertisement, but Mumu, Yahoo Finance, or maybe whatever broker app that you have, FSM1 and whatnot, you can find all this data over there, right? The historical 10 years performance. You need to find a reliable source. If not, look at their annual report. You take 1 year by 1 year. It's a bit tedious, but the figure is guaranteed to be correct. Not to say anything, but sometimes these broker platforms, the number could be wrong, right? Annual report, absolutely right. So you look at the past 10 years performance, whether which one has the most stable, because when I'm looking into bank, number one thing I'm looking into stability. If I want excitement growth, I will look into cyclical stock or I will look into technology stocks, right? So I look at stability, whether they are growing at least a 5% rate for the past few years. DBS, I have not looked too overly deep into UOB and OCBC, but based on what we're seeing here on DBS, yes, they are able to deliver that on a KGA basis. And secondly, DBS, yes, price to book ratio, they are doing on a premium of 1.8 times. But if we talk about going a little bit deeper, we talk about reinvestment opportunity. Now we know that two things that DBS is doing, and also UOB, two things that DBS is doing. Number one, they are doing additional dividend payout, which is from their excess capital that they have accumulated for the past few years. So more dividend income. If you take that and reinvest and compound that, you will have a better edge, because DBS now, if you forward the first quarter, you analyze the first quarter dividend payout, right? You analyze it, which means you times 4 quarters, you get around 6 point something% yield. According to what the analyst report, they also written 6 point something%. So not from me. And compared to UOB and OCBC, you need to justify whether I'm buying in now at 5 point something% yield. Is there an opportunity for UOB and OCBC increase the dividend payout at the same time not jeopardize their growth? All three banks are at the same level playing field in the sense of they are all buying back their shares. That one is all the same, right? And also the NPL level. Now, DBS, to be fair, 1.8 times price to book ratio, definitely not the cheapest that you can get. But comparatively, yield is higher. So it's a very, very interesting scenario. And also, looking at the historical performance of DBS, UOB, and OCBC, if you take the share price performance, there's something very interesting in the capital market and over in the stock market is that the one stock that is favored is always going to stay premium in valuation. And vice versa for companies that are not so favored, they will always have a discount. This is how it's nothing relative to fundamental, nothing relative to the psychology. Sorry, nothing relative to the valuation, but it's something psychological. People tend to buy the number one. You remember the number one, right? DBS is something I would say happened in this scenario, right? So that's my comment on how I look into the three. Historical financial performance for past 10 years, the CAGR growth, current dividend yield, which give me the opportunity to reinvest the dividend that I get into other things, including their own shares, and also the ability to grow going forward. I hope that somewhat enlighten your choices on these three companies. Okay, so we have reached 9:03. I know I talk a lot, but hopefully you guys have get some insight out of it. Actually, I prepare 6 companies, but I guess because of the time issue and a bit of explanation here and there, we couldn't really finish all these companies. But I hope to catch you guys next time. If you guys have any question after the session, if you're watching a replay, you have any question, feel free to drop a text to Equities Tracker to get a hold of me so I can try to answer whatever questions you guys have in the permittable range. Don't ask me what to buy. Okay, so once again, thank you everyone for joining us tonight, and thank you to those who are watching replay, and thank you Equities Tracker for having me today. Thank you very much.